Our analysts are always on a mission to make great stock picks for our community. But rarely do we get to dive into their minds and learn more about them and what drives them to make these choices. What really makes them tick? This is Analyst Analysis. Today we are joined by Tim Beyers. He's been a contributor to Fool.com since 2003 and is currently a full-time analyst for multiple premium Fool services like Rule Breakers. Today we're going to take a deep dive into the mindset of Tim and what factors influence his stock picks. We'll also be asking Tim for any tips he would give to either newcomers to the stock market or anyone who is ready to take on a bit more risk with their portfolio in order to increase their earning potential. And of course, I can't talk to an amazing analyst like Tim without asking him one of the most common questions we get from our audience: where should you invest $1,000 right now? It's going to be a great discussion, and I hope you stick around until the end. So to start us off, Tim, I'd love to ask you, in like a general sense, what do you think is the most important lesson for those who are looking to get into the market and start making picks for their own personal portfolio?
I believe that Peter Lynch, who wrote One Up on Wall Street, which, with apologies to David and Tom Gardner, is the best basic starter investing book of all time. And I think David and Tom, even when they wrote the Motley Fool investment guide, they actually wrote a book after that. And I forget the name of it, but was like the kind of money starter guide, because they recognized that the investment guide was a little bit more advanced because it had some advanced strategies in there of things like shorting. But One Up on Wall Street, when Peter Lynch wrote that, it's still my favorite investing book of all time because it has there's a lot that goes around this idea, but the principle is if you invest in what you know or can learn, you will have a strategic advantage with this one really important caveat. If you build a portfolio of businesses, you're going to be willing to hold for a really long period of time. If you're going to try to trade those, you will lose every advantage that you have. That really is the key. More than anything else, the stocks that you buy are less important than your ability to hold a portfolio for a long period of time. Because, and here's the number one principle to that. So as I get to the stocks that I invest in, it's more important that you know this. If you buy a stock at $100 a share and then you hold it for 10 years, and let's say in that 10 years, it goes to 600. So it's done really well. So now it's $600 a share. If that stock goes up 1% in a day, so that is $6. It goes up $6 a share, during that day. That's a 1% gain for somebody who bought on that day. But for the person that bought the 10 years prior, that's a 6% gain. Nothing else has changed, but what is a 1% gain for somebody is a 6% gain for somebody else. No dividends, nothing else happened. Time gave you a 6x increase on your return. I'm more than anything else, when we talk about this stuff, I really want that to sink in for people. Nothing else has to happen. Just the business has to perform. The stock price grows. You didn't get any dividends. You got nothing else. But the revaluation of that business and your ability to hold on means your return gets better. That simple mathematical principle, by the way, is why Warren Buffett made the vast majority of his money after age 65.
That's a great take. I think it's like what Albert Einstein said. I think it was compound interest is like the most powerful force in the universe. And people like Warren Buffett are absolutely living examples of that. Piggybacking off of that wisdom from Peter Lynch, I'd love to know how you apply that to your own personal investing style.
So how do I approach this? Back to Lynch, buying what I know. I started many years ago after I left the business of sports reporting and sports PR. I went and moved into tech PR and marketing because I'd always been tech interested. And so over the course of my career, learning to speak tech, that's the best way I can describe it, because it is like a foreign language. There's a lot of concepts that are difficult to understand. There's a lot of acronyms that make no sense, but are about silly things like RAID, which sounds really advanced, but it's just a random access of independent disks. That's it. That's all it is. And there's a lot of that in tech. And so being able to translate that, it just became an area of extreme interest for me. So the vast majority of my portfolio is in tech. And so when I am investing, I'm looking into tech because that's where I have a little bit more intellectual comfort. I won't say edge. There are smarter tech investors than me, and there are people who know tech more deeply than I do. But I've had enough time and enough interest to spot some patterns that allow me to buy tech stocks that I think are important. And the number one pattern I found is when the mainline people, either IT managers or just general populations, or most important of all, people who build software, when they line up behind the technology and say, yep, I'm going to spend my time there, you should pay attention. You should pay attention when that happens, because they're telling you that I'm willing to bet my livelihood, in the case of software developers, I'm willing to bet my career, or if they're an independent software developer, my ability to make money on this technology right over here. If they're telling you that, then even if you don't fully understand the technology itself, that should say something to you. Where people spend their time and prioritize does have meaning. So you should pay attention to that. And that's kind of where I've spent time, talking to people, reading stuff, finding out where these populations end up spending time and talent, or investing even their own money to start up businesses. This helps me to get a sense of what's worth taking a closer look at.
Tim, it is so interesting to hear your journey going from, like you said, the world of sports reporting to now being in the position you're in now, and more importantly, being self-taught in investing. I'd love for you to give some, words of encouragement to those who are maybe in a position that they're not super happy in, or maybe just want to invest in their future for themselves or their family, but they're afraid of something as daunting as investing. What would you tell those people?
Right, but like on the point of your returns and the money that you make accelerates over time, it is very much like a boulder rolling downhill. At first, and this is, I do empathize with newer investors, because it can be really challenging. I think it is fair to say it's a little bit Sisyphean. You're starting to roll the boulder uphill. You are in the beginning, and no one should make you believe that if this feels hard, should try to diminish your feelings on that. It is hard. You are putting money to work, and you are literally it is like pushing a boulder uphill. What is harder to see, the over the horizon result, is that there does come a tipping point, and then you get to the top, you get to the summit, and now that boulder starts going downhill, and oh boy, the acceleration curve really does matter. So it is worth it.
That's an awesome way to put it, and an awesome analogy. Is there any personal experience you can speak from where you've had that moment of hyper accelerated growth, like you talk about, like a certain company in your portfolio kind of exploding in growth?
Yeah, let's see. So Taiwan Semiconductor, I have held since, let me go back here. I originally bought in June of 2006. I've reinvested dividends every year. And by doing that, let's see, by reinvesting dividends every year. So today, let's call it 260 extra shares I have bought just by virtue of having dividends, and my overall return on that stock, it is up 21x.
And Taiwan Semiconductors is like a company that has seen massive growth. So I can imagine that has done exceptionally well over the past couple of years for you.
Over the last year was 10x of that 21x. It's the boulder rolling downhill, because it finally became now we know about this company. It has become an essential part of the world's supply chain, because we're more dependent on semiconductors than ever before. And so I've held it long enough for that to materialize. And, as it's grown, it's grew really fast. And so the fast growth that other people were seeing, for me, it was just logarithmically bigger because I'd held it for so much longer. So was I smarter? Nope, not at all. It would be disingenuous to say that. I just was a more relentless holder of those shares. That's it.
Wow, that's incredible. Now, Tim, you've mentioned how you invest in what you know and companies that you believe in. Is there an example you can give for our viewers as to how that logic can be applied and sort of the thought process that goes along with that?
I mean, if you like Amazon or you hate Amazon, it doesn't matter which side of the equation you are on. One thing is clear: Jeff Bezos had a very big vision, continues to have a very big vision, was a relentless pursuer of excellent outcomes, and a really careful allocator of capital invested in parts of the business to achieve those outcomes. It wasn't just squashing people. That's not the entire story of Amazon. There are some troubling parts of Amazon's story. You cannot dispute that. But that is not the entirety of Amazon's story. Also part of Amazon's story is the beginnings of Amazon in rundown offices where they were literally using doors for desks. That's what they did. That's what they did. Like very careful uses of capital. One pizza meetings, like that's a part of the story as well. So there are elements of companies, and you should know the entirety of the story. You should know the narrative. You should know what they're trying to achieve. You should know how they're trying to achieve it. And then you should have some sense of measuring whether or not they're successful, so that you can decide whether or not, I don't know if I should stick with this anymore. That's fair. But when we sell because I don't know that the vision and the execution are really lining up anymore, or I have a hard time believing in this. So taking the Amazon example to a further extreme, it's a perfectly legitimate reason to say, I think that Amazon is winning on the backs of workers, and I don't like that it is a nightmare to work in an Amazon warehouse. If you have some evidence and you know firsthand that that is happening and you're uncomfortable with that, you 100% should sell. You should, because it doesn't reflect who you are. You should sell. Absolutely. So it's you want to be able to have businesses that that you can measure, that you believe in, and you want to hold for a long period of time, because more than anything else, what determines your outcome is your ability to hold for a long period of time. So if you are holding on to a business that you just like, I'm going to hold my nose and hang on to this one because the Motley Fool said I need to hold on for a period of time, that serves you poorly. Because at some point you're going to say, screw this thing, I'm out. And you may be making that decision at a bad time. And we don't want that for you. Does that make sense?
Absolutely. Now, before I let you go, Tim, I know we're running short on time, but I have a special lightning round question for you. It's what the people want to know, Tim. Where is the best place, in your opinion, to put $1,000 right now?
The best place to put $1,000 right now is into the future development of work, where work is heading. And I think that is remote first, cloud hosted, automated processes distributed around the world. You're going to have a globally interconnected supply chain and workforce, and the infrastructure to build that is an immense investing opportunity. And there are many companies that are well positioned for that, but I don't know that anyone is better positioned than Zoom is. Zoom's a great company. Zoom has gotten knocked around a bit because we thought it's a pandemic story. I don't think that's true. I still think we're headed to a hybrid world, but I think what we're missing is that Zoom can really win in that world. Zoom can really win in that world because there's a big business for them, and we've done this in outfitting conference rooms. That's going to happen. There's going to be hybrid workforces, and that conference room and how good that experience is inside the conference room, and how the remote people come in and how they experience the conference, like the people in the conference room, and what that feels like from the remote perspective. There's a lot of innovation that can happen there. It will happen. And I think it's Zoom and Microsoft that are going to compete for that. It's a big, fat market. And I think Zoom is in a good place.
Tim, thank you so very much. I really appreciate your time and having this little chat. If you want more of the wonderful Tim Beyers, you can find him in all sorts of places over at Fool.com. And if you like this video, be sure to leave a like. It genuinely helps out the channel so we can continue on our mission to make the world smarter, happier, and richer. Please be sure to leave a comment as well with questions you would have for any future analysts we bring on. We'd love to hear them. And as always, stay foolish.